In today's video, we're going to look at common mistake beginner investors make when investing in 401k, which may lead to stagnation in their portfolio or even hefty fines and tax obligations, so that you can avoid while investing in 401k. Embarking on your retirement planning journey can feel daunting, especially when navigating complex investment accounts like the 401k plans. It's a crucial tool for building a large nest egg, but it's not without its potential pitfalls. Novice investors often make easily avoidable errors, missing out employer matches to making rash decisions while changing jobs. Understanding and avoiding these common missteps can optimize your retirement savings and secure your financial future. Today's video will dive into 7 common mistakes beginners often make and provide you actionable tips to help you avoid these traps that derail your ability to build your 401k account over the long term. Mistake number 1, not making the full contribution to take advantage of the company's 401k match. One of the most common mistakes made by beginner investing in a 401k is not contributing enough to take full advantage of the company's match. Many employers offer a match, meaning they contribute the same amount as you, up to a certain percent of your salary. This is essentially free money that can significantly boost your retirement savings. A company match is an immediate 100% return of the money you deposit into your 401k account. The first thing you should do is to get that full match. For example, let's assume that your employer matches your contribution dollar to dollar up to 5% of your salary. If you make $50,000 a year and only contribute 3%, that is $1,500, you are leaving $1,000 on the table. You deposit the other $500 and the company adds $500. That $1,000 could earn you returns and compounding over the years. So always ensure you're contributing enough to get the whole match. Cashing out when you change jobs instead of rolling it over. Many people might be tempted to cash out their 401k balance when changing jobs, rather than roll it over to an individual retirement account with a broker. This could be a costly mistake. First, if you are under 59.5 years of age, you will be hit with a 10% early withdrawal penalty. On top of that, your withdrawal would be subject to a regular income tax. By cashing out, you lose out on the potential growth your investment would have earned if they stayed in the account. Over the long horizon, this could mean a significant loss in the retirement savings. Mistake number 3, not increasing contributions over time with your income. Another mistake to avoid is not gradually increasing your contributions over time, especially as your income grows. As you earn more, saving and investing more is essential. Even a slight increase can make a massive difference over the long run due to the power of compounding. If you started contributing 5% of a $40,000 salary, you would contribute $2,000 yearly. If your salary increases to $60,000 per year, maintaining the same rate means now you contribute $3,000 yearly. However, by increasing your contribution rate to 7% could contribute $4,200 a year, providing a larger base for compounding interest and increasing your retirement savings significantly. Always maximize what you contribute as soon as possible as your income rises. Mistake number 4, not managing your capital to optimize investment performance. While a 401k is an effective tool for saving for retirement, it doesn't manage itself. It requires regular review and adjustments to optimize investment performance. Many beginners neglect this aspect, leaving their investments on autopilot and never investing in a portfolio of mutual funds. At times they do, but never rebalance their portfolio based on performance. It's crucial to have an investing system with an edge to manage your capital within your 401k. You need to be growing your capital through investments. Your 401k's performance is largely based on how you allocate your contributions among different investment options like bonds and mutual funds. Regularly reviewing your asset allocation and rebalancing it according to your risk tolerance and time horizon can optimize your returns and mitigate potential risks. Mistake number 5 is holding too much of your company's stock. While it's great to have faith in your employer, holding too much of your company's stock in your 401k can be risky. If the company goes under, you could lose your job and a significant portion of your retirement savings. Having no more than 10% of your total investment portfolio in company stock is generally recommended. However, if they offer any kind of match or discount for buying company stock, in that case, that can be an opportunity to increase returns, and you should be able to rebalance the holdings ladder. Mistake 6 is not managing your capital for risk. Investing involves risk, but the risk can be managed. One common mistake is not balancing your 401k investment to suit your risk tolerance. Too much risk can lead to high volatility. while too little risk might result in returns that don't outpace inflation. The key is diversification, which involves spreading your investment across various sectors, countries, and market caps to reduce exposure to any single investment. As a rule of thumb, the closer you are to retirement, the more conservative your portfolio should be to protect your accumulated capital. However, when you're young and have many working years ahead, you can afford to take more risk for higher potential returns. Mistake number 7 is not understanding the difference between a traditional 401k and a Roth 401k. Many beginners don't fully understand the difference between a traditional 401k and a Roth 401k, which can lead to less than ideal decision making. The primary difference lies in the tax treatment. Contributions to a traditional 401k are made with pre-tax dollars and are tax deductible. However, withdrawals in retirement are taxed as ordinary income. This can be good if you have a high income tax rate now, but you will have a much lower tax rate in retirement. On the other hand, contributions to a Roth 401k are made with after-tax dollars, meaning they are not tax deductible. The advantage though is that the qualified withdrawals in retirement are completely tax-free. This could save you a lot in taxes if you anticipate being in a higher tax bracket in retirement. Choosing the correct type of 401k depends on your circumstances, including your current tax rate, anticipated retirement tax rate, and your overall financial goals. Sometimes splitting contributions between both types may be beneficial to diversify your tax risk. Effectively leveraging a 401k plan demands strategic planning, comprehensive understanding, and capital management. Avoiding pitfalls such as underutilizing employer matches, hasty cash outs during job transitions, stagnating contributions can substantially impact your retirement savings growth. A well-balanced investment portfolio that reflects the proper risk level, regular investment performance assessment, and informed decisions around tax implications can collectively enhance your 401k investment strategy. Firm grasp of this principle will strengthen your financial security and pave the way for more prosperous and stress-free retirement. Investing in a 401k is a powerful tool for securing your financial future. By avoiding these common mistakes, you can optimize your contributions, manage risk effectively, and build a substantial nest egg for retirement. Remember, the earlier you start and understand how your 401k works, the better off you will be in the long run. Consider opening a brokerage account to maximize your retirement savings. A brokerage account allows an investor to deposit funds with a licensed brokerage firm and then buy, hold, and sell a wide variety of investment securities. Brokerage accounts and 401ks offer different advantages and disadvantages for investors and savers alike. Brokerage accounts are taxable but provide much greater liquidity and investment flexibility. 401k accounts offer significant tax advantages at the cost of tying up funds until retirement. Both types of accounts can be useful for helping you reach your ultimate financial goals, retirement or otherwise. Consider working with a financial advisor as you pursue your investment and retirement goals. Subscribe to our channel so that you won't miss any of our videos on personal finance and you get notified. Thank you for watching. See you next time.